What if I told you that one of the world's largest banks systematically defrauded precious metals markets for nearly a decade, racked up a $920 million penalty, and right now in 2026, they might be doing it again with a new twist that's causing retail investors to panic? Before we dive deep into this explosive case, hit that subscribe button and turn on notifications. You're going to want to follow this coverage, because what I'm about to reveal affects every single person who invests in silver, gold, or any precious metal. This isn't conspiracy theory, this is documented federal crime. And the question on everyone's mind in 2026 is critical. Did JPMorgan really stop, or did they just get better at hiding it? And why are rumors spreading that they've just flipped from massively shorting silver to suddenly going bullish, leaving retail investors caught in the crossfire? Let's go back to September 29th, 2020. The US Department of Justice drops a bombshell. JPMorgan Chase, one of the most powerful financial institutions on planet Earth, agrees to pay $920 million in criminal penalties. But here's what makes your blood run cold. This wasn't a one-time mistake. This wasn't a rogue trader. This was a coordinated, systematic scheme that ran for 8 years, from March 2008 to August 2016. Think about that timeline. The 2008 financial crisis, the recovery, the entire Obama administration. And throughout all of it, JPMorgan traders were manipulating precious metals markets, gold, silver, platinum, and palladium, in what prosecutors described as tens of thousands of episodes of unlawful trading. Tens of thousands. The Department of Justice didn't mince words. Acting Assistant Attorney General Brian C. Rabbit stated, and I quote, "For over 8 years, traders on JPMorgan's precious metals and US Treasury's desks engaged in separate schemes to defraud other market participants." But here's the question that should terrify every investor. If they did this for 8 years before getting caught, what makes us think they're not doing it right now in 2026? Now, let me break down exactly how they pulled this off, because this is where it gets technical. But stay with me, this is crucial. JPMorgan traders used a technique called spoofing. And no, that's not some ghost term. Spoofing is when traders place orders they never intend to execute. They're fake orders designed to manipulate the market. Picture this, you're at an auction. Someone keeps bidding up a painting, making you think it's incredibly valuable. You bid higher and higher. Then, at the last second, they withdraw their bid. You're stuck paying an inflated price for something that wasn't actually worth that much. That's essentially what JPMorgan did, but they did it tens of thousands of times in the precious metals markets. The DOJ documents reveal that traders in New York, London, and Singapore placed massive buy and sell orders for gold, silver, platinum, and palladium futures contracts, with the intent to cancel them before execution. They were, quote, injecting false and misleading information concerning the existence of genuine supply and demand. Translation? They were lying to the market. They were creating fake demand and fake supply to move prices in directions that benefited JPMorgan and harmed everyone else, but it gets worse. On certain occasions, traders engaged in activities specifically designed to trigger or defend barrier options held by JPMorgan. These are essentially bets that pay off when prices hit certain levels. So they weren't just manipulating markets randomly. They were manipulating them to hit specific price points that would make JPMorgan money. And remember, this is admitted. JPMorgan admitted to this in their deferred prosecution agreement. This isn't alleged, this is confirmed. Now let's talk about who got caught, because this is where the details get personal. John Edmonds, 38 years old, Brooklyn, New York, a precious metals trader at JPMorgan. He pleaded guilty in October 2018 to commodities fraud and conspiracy to commit wire fraud, commodities price manipulation, and spoofing. As of the DOJ press release, his sentencing hadn't even been scheduled yet. Christian Truns, 35, from New York, another precious metals trader. He pleaded guilty in August 2019 to conspiracy to engage in spoofing and spoofing charges. His sentencing was scheduled for January 2021. But here's where it gets even more interesting. The Justice Department obtained a superseding indictment against 3 former JPMorgan traders, Greg Smith, Michael Nowak, and Christopher Jordan, plus 1 salesperson, Jeffrey Ruffo. They were charged with racketeering conspiracy. That's the kind of charge you typically see in organized crime cases. The government wasn't calling this market manipulation. They were calling it organized crime. And here's a critical detail that should make every investor nervous. The DOJ admitted that numerous traders and sales personnel were involved. This wasn't 3 or 4 bad apples. The document says numerous traders and sales personnel in New York, London, and Singapore. How many people does numerous mean? 10? 20? 50? We don't know, but what we do know is that this was widespread across JPMorgan's global precious metals operation. So let's talk about that $920 million penalty. Sounds like a lot, right? Wrong. JPMorgan Chase reported net income of $48.3 billion in 2019, the year before this settlement. That means this $920 million penalty represented less than 2% of their annual profit. Imagine if you made $100,000 a year and you committed fraud for 8 years and your penalty was $1,900. Would that stop you from doing it again? But wait, it gets more insulting to justice. The penalty was split between multiple agencies. The Department of Justice, the Commodity Futures Trading Commission, and the Securities and Exchange Commission all got pieces of it. And here's the kicker. Some of those payments were credited against each other. In other words, JPMorgan didn't even pay the full $920 million in cash. They got credits. And there's something even more disturbing in the DOJ documents. The government noted that, quote, substantially all of the offense conduct occurred prior to a previous guilty plea JPMorgan made in May 2015 for manipulative trading practices in the foreign currency exchange market. Listen to it again. JPMorgan pleaded guilty to market manipulation in 2015. And then we find out that they were already manipulating precious metals markets when they made that guilty plea. They got caught manipulating one market while actively manipulating another. The DOJ gave them credit for cooperation and remedial measures. They praised JPMorgan for suspending and ultimately terminating individuals involved and adopting heightened internal controls. But here's my question. If the controls were so great, why did it take 8 years to catch them? And why should we believe those same controls will work now? Oh, and by the way, I haven't even told you about the second scheme yet. The same deferred prosecution agreement covered a completely separate scheme in U.S. Treasury markets. From April 2008 to January 2016, JPMorgan traders in New York and London manipulated U.S. Treasury futures and the secondary cash market for Treasury notes and bonds. The same spoofing technique, thousands of instances. The U.S. Treasury market, which is supposed to be the safest, most stable market in the world, the benchmark for global interest rates, was being manipulated by JPMorgan traders. Think about the implications. When the Treasury market gets manipulated, it affects interest rates, it affects mortgage rates, it affects corporate borrowing costs, it affects your cost of borrowing. This wasn't just about some traders making extra profits. This was about distorting the fundamental financial infrastructure of the United States. And they did both schemes, precious metals and treasuries, at the same time for nearly a decade. Now, let's zoom out and look at the pattern, because this is where things get truly disturbing. JPMorgan has a track record here. May 2015, guilty plea for manipulative trading in foreign currency exchange markets. September 2020, deferred prosecution agreement for precious metals and treasury manipulation from 2008 to 2016. And here we are in 2026, and silver prices have been experiencing unusual volatility. The DOJ documents reveal something chilling. They note JPMorgan's, quote, failure to fully and voluntarily self-disclose the offense conduct to the department. Translation? JPMorgan didn't come clean. They got caught. And the government decided not to impose an independent compliance monitor because JPMorgan convinced them they'd reformed. They hired hundreds of new compliance officers. They improved training. They revised surveillance programs. But ask yourself this. If a bank can run 2 separate market manipulation schemes for 8 years, involving numerous traders across 3 continents, and their compliance systems never caught it, why should we trust those same compliance systems now, just because they've been enhanced? Which brings us to the critical question for 2026. Is JPMorgan manipulating silver again? Here's what we know. The manipulation stopped in August 2016, supposedly, but that's when they got caught, not necessarily when they stopped. The investigation and settlement took until 2020. Since then, silver markets have experienced extreme volatility. The Reddit, Wall Street silver movement in 2021 accused major banks of ongoing manipulation. Silver prices have swung wildly, often disconnected from fundamental supply and demand. But now, in 2026, something extremely suspicious is happening. And this is where retail investors need to pay very close attention. Rumors are spreading across financial markets that JPMorgan has completely flipped their position on silver. According to market whispers and trading floor chatter, JPMorgan allegedly spent months, possibly years, building massive short positions in silver. They were betting against silver, driving the price down. And now they're supposedly flipping bullish. Think about what this means. If these rumors are true, JPMorgan could have profited enormously on the way down with their short positions. They pushed silver prices lower and lower, and retail investors, the everyday people trying to protect their wealth with precious metals, watched their investments decline. But here's where it gets sinister. Once JPMorgan has squeezed every last dollar out of their short positions, once they've driven the price down as far as they can, they flip. They go long, they start buying silver. And what happens when one of the world's largest banks suddenly turns bullish on an asset they've been shorting? The price starts to rise. And JPMorgan profits again, this time on the way up. Retail investors are panicking right now, and they have every right to be concerned. Because if you were holding silver while JPMorgan was allegedly shorting it, you watched your investment lose value. And now, just as you might be thinking about selling to cut your losses, JPMorgan flips bullish and the price starts recovering. This is the classic Wall Street playbook. Drive prices down while you're short. Retail investors panic and sell at the bottom. Then you flip long, prices rise, and retail investors who sold at the bottom watch in agony as the asset recovers without them. But here's the terrifying question. Is this market manipulation happening again, just in a more sophisticated form? Remember, we're talking about the same bank that admitted to tens of thousands of fraudulent trades over 8 years. The same bank that used spoofing to create false supply and demand signals. The same bank that openly disregarded US laws for nearly a decade. Now, I want to be crystal clear. These position flips, the rumors about shorting and then going bullish, this could all be legitimate trading strategy. Banks are allowed to change their positions based on market analysis. That's not illegal. But when the bank doing it has a documented history of market manipulation in the exact same markets, when they paid $920 million for doing essentially the same thing before, when retail investors are the ones getting crushed while JPMorgan profits on both sides of the trade, we have to ask the hard questions. Is this just sophisticated trading, or is this manipulation 2.0? Now, I can't prove that JPMorgan is manipulating markets today. No one can, until they get caught, if they're doing it. That's the terrifying part. But consider the incentives in the current situation. The penalty was a slap on the wrist relative to JPMorgan's profits. Nobody went to jail at the executive level. The bank got a deferred prosecution agreement, meaning if they stay clean for a period, the charges can be dismissed. The techniques for manipulation are sophisticated and hard to detect. And right now, retail investors are watching in real time as this potential playbook unfolds. You have everyday investors who bought silver thinking they were protecting their wealth from inflation, from currency devaluation, from economic uncertainty. These aren't Wall Street insiders. These are teachers, nurses, small business owners, retirees. And if these rumors about JPMorgan's position flip are accurate, these retail investors got caught on the wrong side of both trades. They held silver while it was allegedly being shorted down. They're panicking now, many selling at losses. And now JPMorgan supposedly goes bullish, and the price starts to recover after retail has already sold. This is wealth transfer at its finest, from the many to the few, from Main Street to Wall Street, from retail investors to institutional giants. The question every silver investor needs to ask right now is, am I making investment decisions based on real market fundamentals? Or am I being moved around the chessboard by banks that have already proven they're willing to manipulate these exact markets? And here's the most important point. The DOJ itself admitted that JPMorgan traders operated, quote, openly in disregarding US laws for nearly a decade. FBI Assistant Director William Sweeney said traders and sales personnel, quote, openly disregarded US laws. Openly for a decade. If the culture was so brazen that traders felt comfortable openly breaking the law for 10 years, do we really think a fine and some new compliance officers changed that culture? The deferred prosecution agreement requires JPMorgan to report any future violations and cooperate with investigations. They have to enhance compliance programs and report on remediation. But here's the catch-22. We're relying on JPMorgan to police themselves. The same institution that failed to catch 8 years of systematic fraud is now responsible for making sure it doesn't happen again. So, is JPMorgan manipulating silver again? I can't give you a definitive answer. What I can tell you is this. They did it for 8 years without getting caught. The penalty was minimal compared to their resources. No executives faced criminal charges. The same market dynamics and profit incentives exist today. Detection is incredibly difficult. And now, in 2026, we're seeing the exact pattern that would benefit a manipulator. Dramatic price movements, retail investor panic, and rumors of massive position flips by the same institution that was convicted of manipulating these markets before. The real question isn't whether they can manipulate markets again. We know they can. They proved it for nearly a decade. The question is, what's stopping them? A $920 million fine they can pay out of a few weeks' profit? Some new compliance officers who report to the same executives who oversaw the previous manipulation? The enhanced surveillance systems that failed to catch tens of thousands of fraudulent trades? Or maybe the real deterrent is that investors like you are now watching, that people are asking questions, that cases like this don't stay buried. So here's what you need to understand if you're a retail investor in silver or any precious metal right now. First, don't panic sell just because prices are moving. That might be exactly what the big players want you to do. Second, understand that when you invest in precious metals, you're not just betting on supply and demand. You're betting that the market is fair, and the evidence shows us that bet hasn't always paid off. Third, if JPMorgan can flip from short to long, you need to ask yourself, do you have better information than they do? Are you trading based on fundamentals, or are you reacting to price movements that might be engineered? Fourth, diversification matters more than ever. If one institution can move markets this dramatically, you can't put all your eggs in one basket. And finally, demand transparency, demand accountability. The only reason we know about the 2008 to 2016 manipulation is because they got caught. How much don't we know about? Drop a comment below. Do you think JPMorgan is still manipulating silver markets? Have you noticed unusual price movements? Let's discuss. And don't forget to subscribe, because this coverage isn't over. The 2020 case covered crimes through 2016. We're now in 2026. The next chapter could be written any day. This has been your deep dive into the $920 million JPMorgan silver manipulation case. Stay skeptical, stay informed. And remember, in markets, trust but verify.